Welcome back to the channel. Marubeni Corporation just dropped a bombshell. A staggering $305.5 billion net profit for the first half, a 28.3% surge year-on-year.
And it's the second highest Q2 profit in their history. On the surface, it looks like an incredible result.
Exactly. Sounds like a massive win.
Yeah.
But here is the critical twist. The company's ability to generate cash from its daily business, its operating profit, actually plunged by 12.9%.
And that's the real story here.
This is the core conflict of Marubeni's earnings report. A bottom line fueled by strategic gains, hiding operational headwinds. In this first part, we will dissect the financial snapshot.
We'll look at why revenue is up 8.0% to $4.2 trillion, even while operating profit is falling.
And we'll go segment by segment, from finance to food to energy, to see where Marubeni is truly making or losing money on the ground. You need to understand this internal battle before you can evaluate this stock. Let's dive in. Okay, so let's unpack this headline result first. Net profit hit $305.5 billion for the first half.
Yeah, and to put that in perspective, that's a huge jump of, $67.4 billion compared to last year?
That's a massive number.
What's fascinating here is the sheer velocity of that. I mean, they're already at a 60% progress rate toward their full-year forecast of $510.0 billion.
So based on that headline, you'd think they were just firing on all cylinders?
You absolutely would.
But then we hit that contradiction. The huge net profit was driven by strategic one-off gains.
Things like asset sales, valuation boosts.
Right, masking the softness in their actual day-to-day business. Operating profit, the true measure, declined by almost 13%. That's a drop of $18.7 billion.
And this really suggests Marubeni is trying to execute a structural transformation. They're moving away from relying so heavily on, volatile resources.
They're moving towards something more stable.
Exactly. These stable, high return on invested capital businesses they call strategic platforms. You can think of it like their main business routes are facing higher costs, but they just sold off their headquarters for a huge profit.
So the cash covers the bills for now.
It covers the bills, but the engine is sputtering. That net profit gives them the runway to make that pivot.
Okay, let's look at the top line. Total revenue was $4,203.4 billion. That's actually up a solid 8.0%.
And that growth was mainly supported by their metals and mineral resources and the food and agribusiness segments.
But that revenue growth didn't really translate, did it?
No, it didn't translate efficiently into core performance. Gross trading profit, which is, the real engine room for a trading company, that declined by 1.6%. It was down about $9.2 billion. And that was a direct hit from lower commodity prices, especially steel-making coal and iron ore. It just shows the resource sector is still a major drag.
And on top of that, it got more expensive to run the business.
That's right. Selling general administrative expenses, SG&A, they increased by 3%, adding another $12.7 billion in overhead.
So margins got squeezed and costs went up. It all leads back to that 13% drop in operating profit.
It does. And yet, despite all these headwinds, management is sticking to that full-year net profit forecast of $510.0 billion.
So they're confident.
They seem to be. And crucially, they've confirmed they've already baked in a $30.0 billion cushion for any potential macroeconomic problems. They're betting big on the second half.
Okay, before we jump into the segments, we need to make something really clear. We keep talking about net profit versus adjusted net profit. Why is that distinction so important right now?
It's everything in this report. The reported net profit, that includes all those one-time non-operational gains, like selling an asset.
The big flashy numbers.
Exactly. The adjusted net profit, which Marubeni calls its core earnings, strips all that out. We're looking for the money they made from their actual businesses, not from selling off the furniture.
Got it. Okay, let's start with the segment that made the biggest splash: finance, leasing, and real estate. This segment reported a net profit of $125.7 billion.
Which is a staggering surge of $85.1 billion year on year.
So where did that come from?
Well, that number is almost entirely noise in terms of core operations. That colossal result was fueled by one single thing: a massive one-time valuation gain.
A one-time gain.
Of about $76.0 billion from integrating their real estate business with Dai-ichi Life Holdings.
Wait, hold on. So their operating profit across the whole company fell by about $19 billion, and they made $76 billion just by rearranging their real estate portfolio.
That's pretty much it.
Is that a transformation, or is that just, asset management covering up a core weakness?
That is the critical question. However, if we strip out that gain, the core adjusted net profit was $33.0 billion.
Okay, so there was still some real growth there.
There was a healthy organic increase of $8.0 billion, and the real growth driver was their mobility business in North America, now Lake and Wheels, which is a key strategic platform.
Right.
That platform is expected to grow its profits by 22% this year, which is why they actually revised the segment's full-year core forecast upwards.
Okay, so if finance was the big windfall, let's see how the old resource engine room did. Metals and mineral resources. This is where those headwinds really hit home.
They certainly did. Net profit here was down by $7.4 billion, which reflects an $8.0 billion decrease in core earnings.
And that's all about commodity prices.
It's a story of price decline. The profit compression came directly from sharp market price drops in their Australian steelmaking coal and the Roy Hill iron ore project. Roy Hill alone took a $7.0 billion hit.
But I saw something about copper being a huge offset.
Absolutely. The segment's decline was significantly mitigated by a really strong $14.4 billion increase in profit from their Chilean copper mining business.
So copper saved the day for them in that segment.
It really did. And that strong copper performance is driving the future outlook so much that management actually revised the full-year core forecast for the segment upward by $4.0 billion.
So they're bleeding on coal and iron, but betting heavily on copper. I mean, current prices are around $11,000 a ton, which is way higher than the $9,900 they assumed. Is that confidence or just hope?
I'd say it's a calculated bet on continued industrial demand, and that bet stands in really stark contrast to what we saw in energy and chemicals.
Yeah, that one was a steep drop. Net profit just plummeted by $18.9 billion.
The numbers there, they look like a massive cleanup quarter.
So what happened?
Well, the root cause was an impairment loss of about $11.0 billion on oil and gas assets.
The impairment, okay.
And then decreased profit from petrochemicals trading added another $4.3 billion in pressure. They're clearing out the old volatile stuff.
So a strategic write-down.
You could see it that way. Management argues this segment is always weighted towards the second half because of their LNG trading business, but still they had to cut the full-year forecast downward by $6.0 billion.
All right, let's move to some of the more stable segments, starting with food and agribusiness. This one looks pretty solid. Core profit of $40.0 billion, a healthy $6.0 billion increase.
And this growth was nicely diversified, which is what you want to see. You had increases from domestic chicken sales, U.S. fertilizer wholesale, and even strong instant coffee gains in Vietnam and Brazil.
So where were the struggles in what seems like an otherwise solid segment?
The main challenge was Helena Agri Enterprises, their agri-inputs retail business. Profit there decreased by $3.4 billion.
Why was that?
It was just a brutal combination of bad weather and a slowdown linked to China suspending U.S. soybean imports. That forced them to revise the full-year forecast down by $5.0 billion.
Okay, now power and infrastructure services, core earnings decreased by $4.0 billion here.
Yeah, down to $33.0 billion. That was mainly driven by earnings normalizing in electricity wholesale and decreases from their IPP projects.
So the big energy price volatility boost is fading.
It is, but this is one of those segments with a huge long-term tailwind. This business is perfectly positioned to capture all that rising power demand from AI data centers and new semiconductor factories.
So they're looking ahead.
Very much so. In fact, they revised the full-year forecast upward by $4.0 billion, reflecting strategic moves like buying bigger stakes in projects like Sunoco Energy in Singapore.
Okay, next up, aerospace and mobility. Core profit here was flat at $26.0 billion. But flat often hides some movement under the surface.
It does. The downside was a decrease in profit from their ship owning and operating business. That was down $5.2 billion. But that was balanced by a really significant increase from the aviation aftermarket and asset trading business.
And that's a strategic area for them, right?
It is. And here's where it gets really interesting. That aviation aftermarket business is expected to achieve a compound annual growth rate, a CAGR, of plus 35% in yen terms.
35%, that's huge.
It's massive core strategic growth, and it's why they bumped up the forecast.
Okay, let's quickly wrap up the smaller pillars. The lifestyle segment saw a core decrease of $2.0 billion. What was the story there?
The main culprit was the deteriorating pulp market. It just hammered their MUSI pulp business. Small increases from car maintenance and ASEAN and Docomo shops just couldn't offset it.
And you contrast that with a clear winner. IT Solutions. Core earnings grew by $1.0 billion.
Yeah, and this is great organic growth driven by Marubeni, Idigio Holdings, and Arteria Networks. The strategic relevance is undeniable. This whole IT digital solutions business is projected to grow its annual profit by 40%.
Wow.
Yeah, so they revised the full-year forecast up. They have a lot of confidence in this digital pivot.
And finally, next-generation business development. Another huge reported leap here.
Correct, and another massive one-off gain. About $8.0 billion recognized as negative goodwill from an acquisition, but the actual core profit grew by $2.0 billion, driven by new pharmaceutical sales.
And the long-term vision there.
It's huge. They're establishing a pharmaceutical strategic platform targeting a population of over 4 billion people across Asia, Africa, and the Middle East by 2031. It's a very long-term play.
We've established the foundation. Marubeni delivered the headline net profit of $305.5 billion, largely due to strategic wins, but the engine room is under strain, evidenced by the 1.6% decline in gross trading profit.
We saw segments like metals suffer from lower commodity prices, iron ore and coal, while energy and chemicals took that huge $11.0 billion impairment loss.
So is this a company making short-term cash by selling its best assets? Or is this the strategic transformation story we've been waiting for? The truth is hidden in the numbers we haven't touched yet.
And in part 2, we pull back the curtain. We will determine how much of that profit was real by stripping away that massive $76.0 billion valuation gain to find the true core earnings.
We'll then explore the plus 35% CAGR strategic platform businesses and the on 100 per share progressive dividend. Finally, we'll present the full risk and reward profile so you can determine if this stock fits your portfolio. You don't want to miss the framework for this critical decision. We are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.